people to start cycling in here and signing on. Real briefly, again, my name is Patrick Camuso, and I'm the owner of CryptoCPA. We work specifically with digital asset investors and Web3 businesses on taxes and accounting. So, really what I want to do here today during this stream and on future streams as well is go over some of the current events that I'm seeing in the Web3 world, in the digital asset world, specifically related to regulatory news, taxes, and accounting. And then also go over some of the current issues that I'm seeing or experiencing working with clients over the past couple weeks and, the past month or so, and sort of giving you guys an update on some of those things and what I'm seeing on my end. And then, of course, answering any questions that you guys have. I'm very interested to hear some feedback and see what's on your mind and, if there's any questions that I can answer for you guys. So, probably one of the biggest pieces of news that I saw come out this week in the digital asset space is the digital asset mining excise tax was not approved as part of the debt ceiling bill, which, I was somewhat happy to see. Obviously, a 30% tax on cryptocurrency mining would have been a hard hit to the industry and to some of my clients that would have had to pay that tax. So, I was happy to see that wasn't approved as part of this bill. But, I've seen different forms of this tax getting pushed in legislation and conversations about legislation for some time now. Bitcoin and the cryptocurrency industry in general, I think sort of has a mark on its back from a regulatory standpoint. And, this whole issue with the perceived consumption of electricity from Bitcoin mining is not helping this case at all. So are we going to see this get pushed into future bills in the future? Most likely. Will it get approved? We'll have to wait and see. But, I don't think this is going to be the end of this, although for now, it's not going to be an issue for us, which is good news. Now, I've seen reports from different news publications and different media sources online that close to 60% of Bitcoin's power comes from sustainable energy sources, which, sort of would take the argument for this Dame tax and flip it on its head. Although, that wasn't acknowledged in this proposal. But again, the proposal was not approved. So this tax is not going to apply now, but we need to watch for that in the future. Another interesting piece of news that I think was in this past week, maybe it was in the past week and a half or so ago, but you probably saw the headlines coming out that MetaMask updated its terms of service, basically stating that it can collect taxes on certain transactions within the wallet. We saw a spokesperson from Consensus basically come out and clarify that further. A quote that they had. I'm trying to see if I have I don't have the specific news source here right in front of me on these notes. I think it was I don't want to say the wrong news source without directly quoting it. So I'm going to post it here after this video. I'll post a link to the news source that provided this quote. But there was a spokesperson from Consensus quote saying, "We are aware of the tweets circulating with inaccurate information about Consensus terms of service. Let's clarify one thing up front. MetaMask does not collect taxes on crypto transactions, and we haven't made any changes to our terms of service to do so. At Consensus, our goal is to make Web3 universally easy to use, access, and build upon. And it's important to note that these terms are not new, and then they go on to basically say that these terms apply to our products that are subject to sales taxes. The tax section in our terms of service fall under fees and payments section, and it's only for products being sold by Consensus." So basically what I take from that is that, they're not necessarily putting this in their terms of service for purposes of withholding taxes for payroll purposes or holding back taxes related to some level of capital gains that they think that their users should be paying. This is strictly from a sales tax perspective. Now, I think there was a lot of backlash and a lot of confusion within the industry because sales taxes are, a subject that's currently going overlooked that I think is going to apply to a lot of different transactions across NFTs and cryptocurrency. So, the whole issue with the MetaMask terms of service, basically they're putting that in there because they're going to need to be compliant with sales taxes, and if there's certain types of transactions that are taking place, they're going to need to be able to collect sales taxes on those transactions in order to be compliant with the state taxing agencies. So that sort of brings me to one of the issues that one of the major tax issues that I've been focused on over the past weeks and months, and that is NFT sales taxes, because to me this is one of the most overlooked aspects of the regulatory environment as it relates to Web3 and the NFT industry currently. Basically, there's over 31 states that tax digital goods and products, and NFTs likely fall into that definition of goods and products. So there's likely over 30 states that have sales taxes that apply to NFTs. Although we've only seen a few of these states over maybe the past 6 months actually provide preliminary guidance and fact sheets related to NFT sales taxes. So we've seen Washington, Wisconsin, Pennsylvania, Minnesota, Puerto Rico, a couple other states and territories start to really get into providing guidance specifically on NFTs and sales taxes. But clearly it's going to be an issue because we've seen states like Washington, for instance, state that these taxes are going to be applied retroactively because they are just an interpretation of existing laws related to digital goods and products that they're now applying to NFTs. So you probably went and purchased an NFT. I doubt you've paid sales taxes on it. It's because almost no sellers are out there collecting these sales taxes. And a lot of it is just due to the current nature of the industry. The pseudonymous nature to most people, non-custodial wallets. They don't want to necessarily attach an identity to those wallets, never mind attaching their full address to their wallet. But in order to get into compliance with sales tax, that's what's going to happen. So if people are going to want to, continue to purchase NFTs in the future and do so compliantly, they're going to have to start providing this information. And that means that, if they want to have wallets that maintain a certain level of pseudonymity, those probably aren't going to be the same wallets that they're using for these types of transactions. But, I thought it was interesting seeing people have this backlash with consensus, just with the fact that they stated that they can collect these taxes on certain transactions. And, there's already an uproar about that. In order for them to collect those sales taxes, they're also going to have to collect all of your information associated with your address as well. So I think, people aren't going to be very pleased when they realize that too, but it's just going to be another step towards compliance and towards the maturation of our industry. So, that's something to, continue to watch out for. If you're selling NFTs, you need to get into compliance with NFT sales taxes as soon as possible. And you need to work with a tax professional to also assess, what retroactive tax exposure do you have? So, this is something that I'm working with people on. It's something that I've also built an automated solution for in terms of, helping with the sales tax sourcing and tax rates and the collecting of it. So if that's something you need help with, don't hesitate to reach out to me. But I think this is going to be a huge issue moving forward. Another trend I've seen is with new clients coming into the firm is just some of them are just completely, what I'm seeing is there's people that are going to firms and they're paying them, good fees, which, are likely commensurate with the work that should be getting done. But then the work products that they're getting are just dismal in some cases, and in some cases aren't even usable and aren't even workable. So if you're out there and you're a Web3 CEO or business owner, or you're a digital asset investor and you're looking for a CPA to help manage the accounting and taxes for your portfolio, you need to make sure that you're doing your due diligence. I just recently spoke with a potential client the other week, maybe like 6 or 7 days ago. And, he came to our firm unhappy with his last firm, and it was just red flag after red flag. Basically, they were lack of communication, or just very drawn out communication leading up to the tax deadline. They filed his return a couple days before the tax deadline. And then here's the really big issues, is that what I'm seeing happen with some people that are coming from these other firms is that they're not doing due diligence on their accounting. It appears that their wallets and their exchange information is just getting plugged into a software, and then they're given the reporting from whatever software they're using, and that's what they go with. There's no due diligence done on the valuations applied to any of the assets that they're buying or selling. There's no due diligence on the ending cost basis data for what the calculated ending cost basis is compared to the actual ending cost basis. And overall, there's no integrity to the calculation. So, a perfect example is with this client who was having these issues and, wants to start working with Camuso CPA. So, I said, look, if you're accounting, and he had multiple years of accounting too. So, I think he was maybe starting from 2017. So, this prior firm did 2017 through 2022. So I said, hey, let's see if this is accurate. Let's discuss the due diligence you did with them. Do you believe it's accurate? If it is accurate, we can just roll over that ending cost basis data for 2022, and we can start our calculations from 2023. Because, if you have this previous work done, there's no reason to pay my firm to redo it all for you, and then, go through all of that work, go through all of that due diligence and back and forth with me. Turns out they never, once I said that to them, they had to go back to the other CPA just to get reporting from them. They never even received any reporting from them. And when we got it, we quickly realized there was no due diligence done on the ending cost basis data. There's multiple assets that clearly should have a cost basis associated with it that has, $0 valuations. There's assets that, according to the client, shouldn't be there because they weren't holding them. There's assets that are missing that should be there. So overall, the ending cost basis data is a mess. And, if you're out there and you haven't done a detailed review of your ending cost basis data that's calculated compared to your actual, that is one of the most important due diligence checks that you can do for the integrity of your calculation. So, going back to this guy, we basically start going through all this and realize that it's all inaccurate. And he paid this firm well over $20,000 for all these years of accounting, because he did have a complex scenario. And, they basically gave him just, work done with no due diligence, no integrity to it at all, just more or less just plugged into software. Here's the output. There you go. So, that's what you need to be avoiding. So the question to ask is, whose fault is that? Is that the firm's fault, or is that his fault? I would say it's both of their faults. Obviously, this firm did not take any professional responsibility, and they certainly didn't hold up their end of the bargain to, handling his accounting and taxes with care and doing due diligence with them. But you need to also consider that you, as the end taxpayer, need to ensure your own due diligence, because ultimately, if you have a tax issue, if you get audited, it's coming down on you, not necessarily on whoever prepared your taxes. At the end of the day, those tax notices are coming to you, and those tax bills are coming to you. So you need to make sure they're accurate, and you need to make sure that you're doing your due diligence as well. So it's just a terrible scenario. And, this is one example of it, but I've been seeing many examples of that lately over the past couple months. For whatever reason, there's just, a lot more people that are working with firms, and then it's like they're not even verifying their ending cost basis data. And the issue with is particularly not verifying your ending cost basis data is that you're not only going to potentially be overlooking inaccuracies for the current year that you're accounting for, but these inaccuracies can also carry into future years as well. So it can be a major issue that is going to have to be addressed. So, you need to really make sure that if you're assessing, like working with the CPA firm on taxes and accounting up front, there should be certain things that you discuss with them before you get involved with them and before you sign any engagement letters and pay any fees. And one of the things that I recommend really scrutinizing and getting your CPA to delineate for you in detail is, what is their due diligence process like, and how do they ensure the accuracy of the calculation? In addition to that, what is the reporting that they provide? And even looking at samples of that before you work with them can be advantageous. So, really getting a feel for their process and the reporting that you're going to get. And in addition to that, depending on the nature of your transactions, understanding the positions that they want to take regarding the taxability of certain transactions, because there are different tax treatments that different firms and different CPAs will take depending on their interpretation of the tax code and of the type of transaction that you're taking place in. So there's a lot of variability in how your accounting and taxes can get done, and of course there's variability in the overall quality of it. And ultimately, it's going to be on you to ensure that there's integrity to your accounting and to your taxes. So, I think that's all I have for you guys here today. I hope you got some value out of this. Comment any questions below, and I'm happy to answer those for you either here today on this stream, or if I don't get to them today, we also can sort of pick these up on the next stream. I'm going to be trying to do these weekly. Again, I'll be covering some of the more current events from a regulatory standpoint, some of the things that I'm seeing in my practice at Camuso CPA, and just trying to deliver the most up-to-date information regarding Web3 accounting and taxes and digital asset accounting and taxes. So I really appreciate you guys listening. I'm going to sign off for now. Until next time.